Thank you all. Welcome. Thanks for tuning in into this discussion. I want to get one thing out first. All of you are winners because you chose to be at the most interesting session we will have today. I'm Atakan Kavuklu. I'm basically the digital money nerd at IBM. And I have the honor to be sitting next to these amazing people here to talk about my favorite topic, which is the future of money. Now, the good thing about being a moderator is I'm the one who asks the questions and they have to answer. So let's see what the future of money will look like. Well, we have 40 minutes. And before I let all of you give a chance to introduce yourselves, I would like to quickly look into the past as well. Where did we come from? Where are we standing today? And then we can look into the future. So back in 2021, when I started in the digital money space, CBDC was the buzzword. Everyone was talking about CBDCs. This was when Facebook, or Meta now, had announced their digital currency project, and the central bankers were concerned about these developments. So all central banks basically were trying to engage into digital currencies. They started to publish reports about CBDCs. Some central banks had a very retail CBDC-focused approach, for instance, the European Central Bank. Other central banks were more focused on wholesale CBDCs. When we look at stablecoins were still in the market. They were active, but they were not really seen as a competition, I think, of the payment landscape. Stablecoins were mostly used for the crypto exchanges, and there was barely any use in traditional payment use cases. Around 2023, I would say token deposits became a thing, or at least more known. And we heard some initiatives going across the globe. I think the most prominent one from JP Morgan. But what happened in the time in between? I think a lot happened. Today, CBDC is still a hot topic. I think more central banks are now deviating away from retail and focusing more on the wholesale aspect of CBDCs. Stablecoins are now regulated in Europe, in the US, in Singapore, and other jurisdictions. And they're becoming more and more important in the payment landscape. And token deposits is still a big question to me. Maybe we can find an answer today, but there's also more engagement that we can see today. So with that out the way, I would like to give all of you the opportunity to shortly introduce yourselves. Please keep yourself short, and then we can start into the discussion. Meglena, please.
Thank you. My name is Meglena Grueva. I'm head of risk at our Unity. Before that, I've worked in consulting, the European Central Bank, a couple of hedge funds. So I'm in, yes, I'll be representing the stablecoin side today.
Max, I'm working at Deutsche Bank as a vice president for its payment strategy. And by that, a big focus is, of course, also on DLT-based money. And to give 3 examples where we are currently active in, we are, for example, currently working on our stablecoin offering, are advising Circle and also Stripe on their stablecoin activity. We invested in Singapore in a fintech called Partior, which is building a DLT payments infrastructure on which we can also in the future issue tokenized deposits. And we participated, maybe some of you joined also the previous session from Besford on the Bundesbank Trigger solution. There we participated in different test runs and will also continue that work in the future. Thanks for having me.
My name is Wolfgang Berger. I'm in IBM as partner and CTO for banking and financial markets. My focus is mainly traditional banking side and financial market side, so legacy systems, application landscapes, very large ones. And on the other side, I'm dealing a lot with how to integrate and utilize tokenized money in that world, but also how to accelerate the tokenized money implementation.
Hi, good afternoon. My name is Lars. I work for a company called Giesecke and Devrient, and because no one can pronounce that, it's also G&D for short. We are a security tech company. We make passports, we make banknotes, we make SIM cards. We also have some digital products, obviously. So, for example, the eSIM in your iPhone is enabled by us. And I have joined G&D about 5 years ago in the digital currency department. We basically do all three of these things: CBDC, stablecoins, and deposit tokens. So thank you for having me here and allow me to share our view on this.
I need the mic again. Thank you. So we are sharing the mic. I hope we don't share all opinions, that we have a more lively discussion. Let us start with the first topic, which is a very recent development, I would say. It's about European sovereignty. Meglena, let me start with you first. So I earlier explained that we have regulations set in place for stablecoins in the US and also in Europe. What key differences do you see between the MiCA regulation in Europe and the Genius Act that was passed by law in the US? And what implications does this have for the future of Europe?
This is a really broad topic, so I'll try to keep it short because everyone has to speak. But in general, so the sovereignty of Europe will depend, I would say, on the way our money moves, right, on the rails of money. And if we look directly at stablecoins and MiCA and the Genius Act, MiCA was set up as a law in response to Libra. The Libra case. The Genius Act came out as a regulatory text a few months ago, and it came out after the United States already had, after we have already seen that predominantly the adoption of stablecoins globally is US-based. 99% of the stablecoins out there right now are US dollar backed. So there is a dramatic difference, I would say, in the two regulations. What the US is trying to do, they set up the Genius Act in a way that they can position the stablecoin, the US-backed stablecoin, as a statecraft, in a way that they can push their debt outside of the country. They have very deep treasuries, capital markets, and the reserves of these US dollar-backed stablecoins are all invested in these markets. For us, the law came and it requires us, for example, a regulated issuer, a significant regulated issuer in the European Union has to keep 60% of the deposits in cash, a significant one, which is a very big difference compared to what the Genius Act says. There are way stricter requirements for Europe, for the issuers in Europe, at least the regulated ones, like OUnity is. So it makes it much more expensive, not harder to operate, but the compliance burden is way, way heavier for us. So
I'll get the mic back. I think I will run around a lot in this panel discussion, as I have to give all of you the mics. Thank you, Meglena. Lars, moving on to you, and a bit of a maybe provocant question. Why, we just heard Meglena's case about stablecoins and how regulation is helping in the adoption. Why does Europe need CBDC, and how may CBDC even strengthen European sovereignty? Let me pass you the mic.
I like provocative questions. So there's a lot of narrative going around on CBDC in Europe being a reaction to something, being a reaction to the geopolitics in the US, being a reaction to Facebook and so on. But I honestly don't buy it. I mean, if you look at Project Stella, if you heard the previous talk, it's almost 10 years old. So many central banks in the region, and for example, Bank of England, first published on CBDC in 2016. Right, so the idea itself is not that young, right? So, from my perspective, I mean, I can't speak on the ECB's behalf, of course, but what the central banks have been doing in the past, they've been monitoring the share between private and public money, and we all know, I guess, probably many people in this room here are increasingly paying digital. They are less reliant on cash, right? So central banks notice that. And they have a clear mission, and they have a clear goal from the side of the legislation. They need to keep or to preserve the role of public infrastructure in payments. Public infrastructure means, for example, T2 and TIPS, so the RTGS side of things, wholesale side of things, but it also means the retail side of things, so what cash used to be. So in my opinion, it's not a reaction to any of those geopolitical trends or that sort of thing, or to stablecoins. It's just about keeping the balance between the private and the public infrastructure. And a strong public infrastructure, of course, I mean, who doesn't like a strong public infrastructure, right? You want to have good roads, you want to have good public service and so on. And this is how we can strengthen the economy in Europe by, you know, keeping the balance between the private and the public sector and having this really strong underlying infrastructure.
Thank you, Lars. Well, so you're saying that it's basically a timely matter of time. Then my next question would go to you, Max. How do the banks position themselves? I mean, there's a lot of developments recently. Lars is arguing that it's just a matter of time. I think some news that we've seen recently suggests otherwise. How do the banks think about these developments?
In that regard, we are not only focusing on stablecoins, for example, but what we see today, to maybe go one step back, today we also don't have only deposits, for example, or only central bank money, but we have different forms of money. We have retail central bank money, which is today only cash. We have wholesale central bank money, which can be only held by banks, basically. And then we have deposits and e-money. And this is something we are currently seeing also developing in the digital or tokenized space, where we have now, at least in the euro area, the digital euro project of the ECB, which would be the cash-like equivalent, but in a digital form, not blockchain-based. We see, so we had just the presentation of the Bundesbank, that the ECB is also now working on wholesale central bank, wholesale CBDC. And we as a bank are working as well on tokenized deposits, improving the deposits we see today. And we, as of now, don't issue a stablecoin, but we see our role in supporting payments by stablecoins, as we can, for example, help clients of us on-ramping from deposits in stablecoins for payments, or, for example, also hold stablecoins on wallets of our clients, which they can then also use for transfers. So I would not only look at, and also when looking at the overall game where we need to be strong, I think we not only need to focus on stablecoins, but on the broad range of tokenized forms or digital forms of money, however you want to call them.
Perfect. Thank you. So it's a lot of horizon scanning, and then also preparing for some of the implications that might affect the banks. Very interesting. Wolfgang, let's turn to you. You're a CTO, so I'll give you like a technical hat at this point. Looking at this from a technical standpoint, how can we as Europe ensure that Europe remains an attractive geolocation for the capital markets?
So if we maybe we need to sort out the terminology a bit. So if you talk about capital markets, then it's primarily a wholesale CBDC. If we go to retail CBDC, then we are in the digital euro, and then we are in the retail space. And I think technically the key question is, if you talk about digital euro, will it be issued on top of DLT, or will it be issued on top of a classic central system? And at the moment, the discussion is very much in between again. So it was very much on blockchain, then it was very much on central. Now it's a bit in between because the discussion and the time pressure is a bit different. But the key question is really, do we need it as a second central system? because we should not forget that we have TIPS in Europe already, so implementing SEPA instant payment, which is perfectly running and settling on central bank money. So we do not have any additional counterparty risk in that sense. And that makes it a bit tricky to argue also towards the benefits of digital euro. I think the wholesale piece is clear. Everybody needs it, so capital markets needs it. We have to have the atomicity in the transactions. So where we have a cash leg and a securities leg or assets leg. And then we have a couple of other topics also for the digital euro, which is the offline discussion and the inclusion topic, where we also have this general public responsibility of the Bundesbank. And technically, from a Euro perspective, we need to look really much into the use cases and what we add in terms of value, and what is then exactly the role play of ECB and the Bundesbank when we are talking about Germany. So where do we see the role of public money in the future? And there was a lot of discussion around enabling everybody, every citizen in Germany, for instance, or in Europe, to participate in the digital economy. and this is where we need to focus on. I think that's my personal opinion, to really have a differentiation. And now we have stablecoins in the picture as well, which is a sort of commercial bank money, if you would like to treat it in that way. So it's of course different issuers. They are not banks. Banks are on the deposit token side. And this is what all needs to get sorted a bit more, and where we clearly need to understand the different use cases and where we have exactly the benefits. And this is, if you go through the dimensions, it's counterparty risk. So are you talking to a bank, tier 1, tier 2, tier 3, or an electronic money token, e-money token issuer? Then it's what technology do you need? Do you need DLT, or do you go classic with a central piece? And these discussions need to be a bit more precise, I think, because at the moment we are very much blurring the lines in the discussions. Yeah.
Long answer, long way for me to reach the mic. No, thank you, Wolfgang. I mean, I think you basically hit the nail on the head. You were talking about how we need to work together, right? The public sector, the private sector. We also need to understand what do we want as Europe for the future of digital money. Maybe that's a perfect segue for our second topic of this panel discussion. Meglena, let me turn to you. We heard that stablecoins are here, and sometimes apparently some people do not very much understand where exactly stablecoins should position themselves. Maybe you can help us answer the question. So where do you position stablecoins alongside the current money landscape, specifically because Wolfgang also mentioned in Europe we do have a functioning payment landscape?
Well, if we look at the existing payment system, we have public money and private money. I mean, just like pure economics. So then now we have digital money, and we also have public digital money and private digital money. The digital euro is the public one, and stable coins and tokenized deposits are the private leg of the digital money. That's basically where stable coins stays. It's one-to-one backed by reserves, by law, and yes, credit risk, just like with banks, exists. That is true. But stable coins, if we talk about like that's exactly where they stay. Then if we look at their use cases, today they're like, obviously like the immediate one is remittances, cross-border payments, treasuries is a big use case. But then in Europe, technically, we can help. I think stablecoins are a natural way to build the so wanted European Union capital markets union on the DOT, because we are all talking for, I think since 2014 the Commission has been talking about building a European Union capital market union in Europe, which we don't have. So we can build that now on DOT, and actually the stable coins are an excellent leg there to settle transactions with securities or any other, and all capital transactions that go. So this is another use case that we can think of. Of course, we have the exchange, the pairs that we work with, all of these things. But these are some of the things. And by the way, about I know that we talked about digital Europe, public-private money. We should not look at it as a competing. They're like complementary. It's like if we talk about the unity of money, technically we should have the euro smoothly flowing from one to another. This is the idea. I mean, how that's gonna happen technologically, or like with no public blockchain on the, if there's no public blockchain on the digital euro case, I do not know how that's gonna happen, but yeah, this is what we have to consider, the unity of our euro.
Great, thank you. Lars, you said you like provocative questions, so I may have one for you. Meglena is saying that basically there's the need from the market, and that stablecoins and deposit tokens are fulfilling that need. How do CBDCs get into the picture? I mean, is there a coexistence between CBDCs and these different forms of, or novel forms of money? Let me go to you again.
A short answer, yes. So I'm totally with Meglena on the coexistence part. I think all of these instruments have their own individual use cases. I mean, case in point, the retail digital euro is not supposed to be used for B2B transactions, right? So we can argue about whether that's a good idea or not. I have my opinion on it. Others probably also have their opinion on it, but it's a fact, right? So for some of these use cases, we hear more about the long stable coins or deposit tokens. So it's totally clear to me that they all have their different use cases. Now, in terms of interoperability, I want to pick up your point as well there again. I think we can do this without a public blockchain, and I think the answer is probably somewhere along the lines of wholesale CBDC. The answer could also be integrated into Target, because as Wolfgang mentioned, Target has an instant payment system today already. And we see, for example, that this year ECB has announced that non-banks can get access to Target services. So they are not allowed to hold their liquidity totally in Target, but they can hold for their daily payment purposes. So I think we're getting there maybe iteratively. And I know this is not the message that blockchain fans like to hear, that we can do something without blockchain, but it is what it is. We can talk again in 5 years, maybe when Pontus is completed and Appia is around the corner. Maybe the situation will look different, but I think as of today, there are already there's some good progress being made to make sure that the system, the singleness, kind of the unity of money, as you mentioned, keeps churning along nicely.
So because singleness of money, this is always like, okay, €1 goes for €1 in a different scheme or a different setup, minus fees. There are always fees because all the infrastructures need to be paid for. So this is what we should not forget. And the question is always, how much are you losing when you're transferring between the different areas? Yeah? This is a very important piece. And I think on the DLT part, this is primarily a timing question now. Yeah. If they would have time enough to really build it in DLT, then it would be excellent to do it now. And this is now exactly the question and the competition from my point of view. If you need it on DLT, you go stablecoin or deposit token. If you can actually have it from a central system, you can easily use TIPS. And this is where you need to look into the differentiation. And TIPS is now going cross-currency as well. So we get Denmark, Sweden, others, and they are running their instant payment systems on top of TIPS, and they can also do not only multi-currency, but then in the future cross-currency.
Atomic even.
And even atomic, yeah. And this makes it even narrower for any other setup to really find the sweet spot and to really come with a value proposition into the market for the retail clients. And if we put also the offline discussion with the credit card schemes from the Nordics into the picture, then we see that they are looking into supporting 5 days offline and still allowing transactions for daily goods. So we see also here a lot of movement in the European countries. Yeah.
No worries.
No, but we also, sorry, just then we also, that's great. We also have to have interoperability of like messaging, wallets, compliance checks. These have to flow smoothly from one system to another. That's another very big technical issue that we have right now. So this is not. Yeah.
Well, maybe, Max, you have an answer for that. You're working at Deutsche Bank. Deutsche Bank is currently collaborating with the public sector on Project Agora. Project Agora is an initiative by the BIS and many other central banks and private institutions that focuses on this interplay. Can you maybe tell us some of the challenges you've been facing in this project?
Yes, of course. As already said, most probably it's not a short-term play where we will use DLT for bank transactions. So Project Agora is a project of 7 central banks worldwide with 40 private market institutes, where the goal is to develop a joint new financial market infrastructure on a DLT. And we are currently in the design phase, or we just finished the design phase, where we discussed what ledger do we want to use, which network do we want to use. Have we one joint network of all participants, or one network per currency region, which are then really deeply connected with each other. But Wolfgang, you most probably know it. I know it myself. When you develop big projects in big corporates, this always takes a few hours. And when you then try to develop something with 40 banks and 7 central banks, it might take even longer. And this is definitely a challenge, and also not a quick fix for payments, but more a vision for the next 5 to 10 years on which we and also other institutes in the market are working on, similar to APIA, where the question is, how can we improve over the next 10 years? Because I can only echo, Wolfgang, what you also said on tips. If we want to do a payment between each other, this is today already really cheap and efficient. And the question is then, for which use case do we really need DLT when talking about payments? And you also talked about the initiative connecting different currencies with tips cross-currency. And here we see also several projects popping up worldwide, where the goal is to not only connect within tips, but for example also connect different instant payment schemes, as for example UPI in India and also tips in Europe. This will also not come overnight, but take a few years. And then the big question is, what is the fastest development we see? Is it tips connecting to UPI? Is it Project Agora, APIA, or Nexus, a different project? And or do we see stablecoins in that space, because they might develop faster for connecting different regions of the world?
I heard so many buzzwords: connectivity, interoperability. Wolfgang, turning to you, maybe this can be a shorter question because it might be quite obvious. But if you followed the recent news in the digital money sphere, then you may have seen that Google, Circle, Coinbase are now thinking about building their own infrastructure and basically putting their stable coins onto that infrastructure. What do you think about these developments, and how can we maybe avoid fragmentation regarding the infrastructure?
Well, I think on the fragmentation side, we are now getting into fragmentation first, and then we go into consolidation. Because now these players are trying, and they are large. If you look into the numbers of stablecoins which are in circulation, we have Tether, Circle. Tether is 170 billion, I think, in US dollars. Circle is roughly half of it. but these are very huge numbers. So they want to build now ecosystems which go deeper and broader based on their market power. That's my impression at the moment. And also at the same time to provide infrastructure which is compensating some of the deficiencies which we have in the classic DLT implementation. So giving stability on fees, etc., etc. So addressing really the concerns of the financial industry. Of course, you can do it to some extent on the existing blockchain implementations, but they go now a different step, and we will see who actually will win. And if you look into the hyperscalers, because you mentioned Google as well, they are also building ecosystems because they need to create some stickiness in terms of their clients. And if they go with ecosystem players like the CSDs, what we see, so those who are operating the exchanges in the classical world, then we also see partnerships between hyperscalers and these players. So whenever there is an ecosystem type of setup, then they are looking to get somehow into it, and also to really create the stickiness. And stickiness you can create if you own the platform. For Circle and for Tether, of course, it's the fees topic again, because you pay a lot into Ethereum and others, and this is an additional income stream for them, or revenue stream. But the biggest part is, of course, from the yield of the backings.
Perfect, thank you. Now, bit cautious about the time. Let's move into our third block and the third topic, and maybe we can be a bit faster on the questions, because I still want to open up for the audience as well if you have any questions later. Meglena, again, back to you. We often hear this phrase, the US innovates, Europe regulates. What is your one wish, or maybe multiple wishes, to the policymakers in Europe? How can we balance innovation with regulation better?
Well, a very immediate one that comes is right now. I think you mentioned that now non-bank issuers can have central bank deposits, right? And this is being discussed. I think, especially for stablecoin issuers, it could have been incorporated from the law from the very beginning that licensed stablecoin issuers have access to Eurosystem money, not to go through the discussion now and then with each central bank separately. Right, that's one thing. I think also we should not have the narrative stablecoin against CBDC against tokenized deposit. Should be like all together, as we said, all have different use cases, and then there should be a bit more, because we don't have the network effect like the US-backed stablecoins have. There should be maybe a bit more push from the public sector in Europe as well to incorporate private digital payments like stablecoins as well. Maybe a big public sector pilot can happen where stablecoins are utilized, and this is going to show the people that there is the security and the public trust the private payment railways. These are some of the things that come to my mind immediately. There's way more to be wanted, but...
Any comments at that point? No, okay. I mean, you had very good points. I would still like to come back a little bit, because we already touched upon that discussion. Everything needs to be interoperable. Everything needs to be connected. And Wolfgang, you said that the discussion started from a DLT perspective, open public permissionless networks, then moved into a non-DLT discussion. Now we're opening up again. How do you see the trends today? I mean, how can we even achieve interoperability if we have these siloed systems centralized somewhere in some bank, and then other systems that are maybe in the public permissionless space?
I think the interoperability topic is a very tricky one. So if we cannot manage that we have atomic transactions across the different pieces, if there are different DLTs, whatever the implementation is, then we are losing a lot of the benefits. And this is, of course, the initiative around Appia and Pontes to really get the DLT advantages leveraged in these implementations, because it reduces a lot of counterparty risk. So you can immediately settle, you do not have to reconcile, you know exactly what's happening. If we lose this because we get liquidity locked up in integrations, etc., so all these nitty-gritties and little things when transactions are not working, then we really have a mess, or at least not the big advantage. And this is one of the key topics which we need to get managed and addressed. Yeah. That's my main concern, that we get this really covered and that nobody's working against it because they would like to occupy the ecosystem and make it a closed system instead of an open one. Yeah.
Then maybe, Max, you're again a good guy to ask that question and forward that to you. Again, as someone participating in the banking industry, how does the banking industry look on public permissionless networks, and what challenges do you face specifically in operating on these networks?
What is, from my perspective, quite interesting and to a certain extent funny. 3-4 years ago, all banks only worked on private permissioned networks. So you already, Atakan, spoke about the JP Morgan coin, which is basically just a deposit issued on a blockchain which is completely controlled by one validator, which is JP Morgan. And then the big question is, do we need even a blockchain for that? And what you can observe over the last years, that all those different institutes and also initiatives are opening more up for public blockchains. Today, we have the challenge that regulated institutes are still interested to align to regulation and also have the transactions in their control and also handled in a private manner, that not all data is public. And this is currently a challenge where we have different ideas or options in the room, which are currently getting discussed. For example, also in the manner of Project Agora, where we have, for example, the question, do we use a more controlled layer 2 on a public permissionless blockchain, or there is, for everyone interested, also a project from the Monetary Authority of Singapore, Project Guardian, where all the transactions are happening on a public permissionless network, but only between whitelisted wallets and smart contracts. And here, we are currently in the design and discussion phase, how this could look like. But what we definitely see is this movement from private blockchains to public blockchains, also in the financial space.
Thank you, Max, for clarifying. Now, Lars, turning to you. No, maybe it's the distance between us two now. But Max just answered the question from a private sector, but I think it's also interesting to hear the position of the public sector. You working at G+D as a CBDC service provider, what is your view and perspective on central banks and CBDCs being potentially launched on chain, maybe on public permissionless networks? Is that even a thing? Does it make sense? Maybe you can give us your opinion as well.
I'll keep it short. It's called a central bank and not a decentral bank. Okay, that one took a moment. So I think in terms of retail, there's not really any point in having a public blockchain, because you would need to somehow yield control from the central bank to an anonymous set of randos on the internet to validate each individual retail transaction, and that's just a no-go. So I think in terms of retail, the debate has been settled. I think there's seriously no one considering this. For wholesale, of course, is a different story, but you asked about retail mostly. So yeah, that's really all I can say about it.
Maybe we can also open up. As I said, I had the privilege to ask the questions, but maybe you also have some pressing questions to the speakers.
We have time for one question.
Yes, here in the front.
Yeah, I actually have a question for you, Lars, because
I have the feeling that it's a timing game in the end, because you talked about tips, then there's Agora, then there's stablecoins and so on. What is actually the timeline about tips? Because you said there's already infrastructure there for instant payments, even atomic payments, which is one of the benefits that stablecoin brings. So what is the timeline there?
So TIPS has been around for what, almost 10 years now, or even longer than 10 years. So TIPS TIPS is established. These new developments, non-banks having access, and also cross-currency, that's fairly new. So I think the next biggest thing on the agenda would be the retail digital euro. There's going to be a decision to move forward or not by end of 2025. So that's going to be in not a long time. Yeah. So and then beyond that, I really don't know. You would have to ask the person from Bundesbank who presented earlier.
All right, perfect. Then with that, let me thank you speakers. Let me thank you as the audience. A big round of applause for the panel discussion. I think it was great. And sorry again, Lars.